So in an equivalent way, what you'd call like the equivalence of the ERP in the bond market, saying the same thing. We are entering into a world, no defaults, and entering a world where the stock market will not go down. In fact, the market's telling you when the ERP is zero, that for you to be fully invested in this market, you have to believe that there will never be any sellers. There will never be any sellers. And I guess it comes down to, once again, your first question, Anthony, which is about the big surprise of the year, that everybody talks about the mountain of money on the sidelines. Well, maybe it's a hill now and not a mountain. When you look at the inflows of ETFs, I'm blown away. If you look at the chart of the inflows into equity index funds, passive index funds, that chart looks like Bitcoin. I'm astounded. I'm astounded that we are now up to 60% of the market cap in passive index equity funds. I mean, when John Bogle first unveiled the ETF in the mid-70s, he said this market will never get more than 20% of the total capitalization. We're getting towards 60%, and the inflows are incredible. Looks like a dot-com stock in 1999. And so this is all part of the momentum. And of course, it's all part of the self-reinforcing upward spiral, because these index funds have to invest in the index. And for the public, general public investing, they don't even know what they're buying. They don't even know what it is they're buying. They couldn't tell you one stock in their portfolio. And why bother when you think about it, investing with an active manager when 3/4 of them have underperformed the index and the index is so much cheaper? But then again, active investment management is not blind investing. The portfolio managers or the CIOs, they're skilled. They have their CFAs. Nobody's perfect, but they do look at balance sheets. They do look at income statements. They do look at valuations. But when you're investing in ETF, there's none of that. And that is an unremittent bull market. The bull market at ETF investing, and that money has to be put to work. I guess I didn't anticipate at this stage that when I look at the household financial asset mix, 70% is in equities. Only 12% is in bonds. And that's true. This is from the Fed flow of funds data. Of course, bonds are for losers. You're not going to talk about bonds at the cocktail party. Nobody want to have a conversation with you. And the rest, of course, is in cash. But we've never been at 70% before in terms of the concentration of equities and household balance sheets, not even during the internet era of the late 1990s. This is off the charts. And when you look at baby boomers, the 80 million pig in a python, baby boomers like myself, we should be between 30 and 40% in terms of the life cycle in equities. They are over 60% in their asset mix. We've never seen this before. Everybody is all in at the same time in exactly the same trade. Portfolio managers themselves, looking at the ICI mutual fund data, and I didn't predict this, that we're down to just over 1% liquidity ratio, cash to asset ratio for domestic equity funds. In the overall annals of financial history, we've never come close to being that low. Imagine, God forbid, if we ever see any redemptions. But, those are the surprises. Those are the surprises. And the fact that we still have such huge inflows in equity ETFs with the valuations where they are, even if you're willing to take a long-term view of valuations, which is what I did, it might not be a bubble, but it's a mania. And I don't invest in either one of those.